Yeah, so generally speaking, as far as the stocks that I like to trade, I like trading, liquid, uh, high beta stocks. So I consider them to be the leading stocks, the quote unquote disruptive growth companies. Last year, those were names like Tesla, Cloudflare, Pinterest, Roku, Peloton. I was on all those stocks, and many others too. But really, is what I do is I use the 10 and the 20 period exponential moving average, sort of as a guide to what the trend is. And then I look to utilize chart patterns in my interpretation of volume to find low risk areas to get involved in stocks. And then once I'm involved, I've got my stops in place. So I'm usually risking, pretty tight stops, maybe 1 to 3%. Sometimes just straight up momentum and put a stop in there. And then I'll hold the stock and ride it up the moving averages, up the 10 and 20-day moving average, until they either break the moving averages, or I sort of feel like there's euphoria and there's a good opportunity to sell into strength. And then I just kind of wait for the next opportunity and do it again. So I think the key to my strategy is, one, I'm trading the leading stocks. I really do believe that I'm pretty good at finding those top names. And then two, I'm taking, fairly small risks in relation to the upside of a trade I'm making. So I can afford to, have a bunch of small losers, and, I can catch one big winning trade and it'll more than pay for all the losers. And then three is, I think I take more concentrated positions than most people do. If I have an opportunity from a risk managed perspective to get a 30 to 35% position on a name, I'm going to do that if I think it's worth it. And I'm not buying like, 30 or 40 stocks and putting 2% in each name. I'm waiting for a stock to move. And if I like it, if the earnings are good, if the sales are good, if it's trading near its highs, if I like the story and I think that it's a disruptive company, and I can get into it with a 1 or 3% stop or something in that range, then I'm going to go for it.